Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Sanjiang Fine Chemicals Company Limited annual report. China Sanjiang Fine Chemicals Company Limited is a diversified investment holding company that offers a wide range of businesses and services. At its core, the company manufactures and supplies various chemical products such as ethylene oxide and glycol, propylene, polypropylene methyl tert-butyl ether, MTBE, surfactants, ethanolamine, carbon-4, crude pentene, and industrial gases like oxygen, nitrogen, and argon. In addition to its manufacturing capabilities, the company provides processing services for key products such as polypropylene, MTBE, and surfactants. It also offers lease and storage services, as well as asset management and supply chain management services to support its operations. Furthermore, China Sanjiang Fine Chemicals is involved in the construction and management of a pipe network at Jiaxing Port Chemical Industrial Park. The company's portfolio extends beyond manufacturing and processing services, with involvement in equipment rental business and the manufacture and sale of specialized products such as alcohol ethoxylate, nonylphenols, textile auxiliaries, and polyethylene. This comprehensive range of businesses and services positions China Sanjiang Fine Chemicals Company Limited as a significant player in the chemical industry. China Sanjiang Fine Chemicals Company Limited maintains a market capitalization of $5 billion, broadly in line with the industry peer group. China Sanjiang Fine Chemicals Company Limited trades at a lower price-to-earnings ratio of 12 times and a higher price-to-book ratio of 0.9 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced, even though it is trading at a higher price-to-book value than it peers. We will need to evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap, and if it would be better to be investing in its peers than China Sanjiang Fine Chemicals Company Limited itself. The leverage on the balance sheet appears elevated, with liabilities of 78% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. At the same time, profits have grown exceptionally fast while the share count has declined. This suggests management is generating substantial earnings while actively concentrating value into fewer shares, an extremely positive signal for long-term investors. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in the company's operations can be identified from various product lines. On the growth side, ethylene glycol saw an 18.5% increase due to improved sales volume, average selling price, and gross profit margin. Surfactants also experienced stable revenue due to resilient demand for home care and daily consumption products. Additionally, MTBE witnessed a 7.6% increase in revenue due to higher volume. In terms of new market entries, the company saw growth in mainland China, $558,000, Singapore $259,000, United Arab Emirates $121,600, and Hong Kong $75,800. These regions contributed positively to the company's revenue growth. On the other hand, certain product lines experienced decline in revenue. Ethylene saw a 56.5% drop due to various factors. Butadiene also declined by 24.8%, while ethanolamine dropped by 45.5%. Polypropylene, PP, witnessed an 11.5% decline due to oversupply and lower sector operating rates. EO experienced a 10.2% decline due to lower average selling price and sales volume. Overall, the company's revenue growth or decline is largely driven by its product line's performance in various regions. The net income of the company experienced a significant decline between 2024 and 2025, with a decrease of approximately 23.5% to RMB 407,258. This downward trend continued into 2025, with a further decrease of 7.3%. The profit margins also suffered, with the gross profit margin decreasing by 0.8% from 5.7% in 2024 to 4.9% in 2025. The reasons behind this decline are multifaceted. One major contributor was the compression of profit margins in certain product lines, such as ethylene oxide and several olefin and aromatics byproducts. Additionally, lower ethylene contributions and commodity oversupply in selected product lines further exacerbated the issue. The downstream demand weakness in property-related sectors also played a role in the decline. The overall effect was a significant reduction in profit margins, with a year-over-year decrease of approximately 19.2%. This decline can be attributed to a combination of factors, including market conditions and internal operational challenges. The company's financial performance indicates a challenge in generating positive operating cash flow. Despite an operating cash inflow of RMB 912.5 million, the net cash used in investing activities of RMB 1,549.1 million outweighs this amount, resulting in a negative overall operating cash flow of RMB 407.3 million. This suggests that the company's investments are currently exceeding its available funds, leading to a strain on its liquidity. The company's debt level has experienced a notable increase over the past year. As of December 31, 2025, total current borrowings stood at RMB 10,438,720,000, marking a significant jump from the previous year's figure. Furthermore, the overall debt level rose from RMB 10,945,133 to RMB 11,796,948. However, despite this increase in debt, interest expenses have actually decreased substantially. In 2024, the company incurred RMB 414,656 in interest expenses, but by 2025, this figure had dropped to RMB 371,415. This reduction suggests that the company has managed its debt effectively and is paying less on interest payments. The company's performance varied across different segments and regions. On the positive side, China was a standout performer, with strong results reported on page 5. The operating segment 1 also showed impressive growth, although no specific breakdown by product and service was provided. Additionally, the sale of industrial products in mainland China both performed well. In contrast, several regions and segments struggled. The Middle East and the Strait of Hormuz were identified as areas of concern, along with property-linked demand. Processing services in Singapore also underperformed, while the United Arab Emirates and Hong Kong, although considered new markets, did not provide sufficient data for comparison. The others category also experienced difficulties. The company has made significant financial transactions in the form of acquisitions and divestitures. On the acquisition side, one notable transaction was the purchase of notes receivable from banks in the People's Republic of China, PRC, totaling RMB 1,137,675,000. In terms of divestitures, the company has derecognized certain notes with a value of RMB 210,149,000. Additionally, it has also derecognized intragroup notes receivables worth RMB 210,250,000. These transactions demonstrate the company's efforts to manage its financial assets and liabilities effectively. The acquisitions and divestitures highlight the company's strategic approach to managing its financial position. By acquiring notes receivable from banks in the PRC, the company has likely sought to optimize its cash flow and reduce its reliance on external financing sources. On the other hand, the derecognition of certain notes and intragroup receivables suggests that the company is streamlining its balance sheet and eliminating non-core assets. Overall, these transactions reflect the company's commitment to prudent financial management and its efforts to maintain a healthy financial position. The company's financial activities have been notable in recent years. One of the key highlights is its dividend payment history. According to the provided information, the company has a record of paying dividends on multiple occasions, as mentioned on pages 1 and 2. In addition to dividend payments, the company has also engaged in share buybacks. Specifically, it is recorded that the company bought back shares on page 21 of the document. This indicates a proactive approach by the company to manage its capital structure and potentially boost shareholder value through strategic investments. Concerns have been raised regarding the accumulation of excessive inventory levels. Specifically, two instances highlight this issue, one noted on page 23 and another on page 36. These concerns suggest that companies may be facing difficulties in managing their stock levels effectively. Furthermore, there is also a mention of potential risks to supply chain continuity due to geopolitical events. This risk is highlighted on page 5, indicating that external factors could disrupt the smooth functioning of supply chains. That concludes the financial summary for China Sanjiang Fine Chemicals Company Limited. Feel free to comment below, and I will be happy to answer them when possible.